Good morning, everybody. Today is Monday, February 15th, and I'm going to make a follow-up video to the one I just made about Tilray, and this is going to be in regards to options trading. I did get some great feedback on the video I made Saturday in regards to this stock, and I want to follow up with this a little bit and go over some stuff that people may or may not know, getting into options trading. This right here is our 30-minute chart on Tilray. Now, if you had bought an option call down here on the 8th, any point in time here, the 9th, hell, even the, the 10th, and you had bought an option call that was out of the money and this thing hit 67, 70 bucks, you would have made a hell of a profit on that just right off the jump. You'd have made some pretty substantial money off of that call. And then what would have happened if you didn't sell that call that day, you're going to be holding that sucker and it's going to be worthless right about now. So I wanted to go over a couple things. I do think Tilray is still going to go up this week for sure. I don't know that it's going to stay up incredibly long, but I wanted to go over a couple different trading platforms and the differences in there for guys who are looking to possibly trade an option. I'm sure a lot of you have seen it if you have not already done so. Options trading basically allows you to control 100 shares of a stock without actually owning the stock. If you have read the news last week, it came up where Robinhood was being sued by the family of a kid who thought he was indebted $730,000 and ended up killing himself over the summer. Well, that's really not how options trading works. So what I'm going to do here is show you three different examples on why options trading is risky on a stock like Tilray. First of all, we look at the 30-minute chart here. This is going to be daily, 8th, 9th, 10th, 11th, 12th, 13th, so on. So we have this huge spike and this huge fall. On an option call, you want that stock to go up exponentially and stay there above your strike price. So in order to show you this, I'm going to pull up Robinhood because Robinhood does an excellent job of actually showing you where you need to be. Despite everything that went down with Robinhood and not being able to buy and sell stocks on there through the GameStop epidemic and stuff like that, I mean, it still does a great job. I use all of these platforms to monitor stocks in their own ways. So I'm going to make another video of that here in just a minute and go over why I use all these different platforms to keep an eye on stuff. But we're going to start here with just this option call. So right here, this is the share price as it closed on Friday at 29.66. We have got a buy option selected, call option selected, expiration date of the 19th selected right here. And what that means is that we're going to buy a $30 strike price, $2.95 a share is what we're going to pay for this contract, right? So it's going to be not $2.95, it's going to cost us $295. We're going to have 100 shares of this. So if we add that there, right there, $30 call, $2.95 expires on Friday. Our break-even point, in order for us to make money on this option, it has to go at or above $32.95, which is an 11% gain, right? So if we say, all right, we think Robinhood's going to go up, or not Robinhood, but we think Tilray is going to go up to $40. We buy this $30 call for 300 bucks. We're controlling 100 shares for $300. That's what we're doing here. So that's great. If we do believe that, we look at our other chart here and we think it's gonna go, yeah, hell, it might go up $35, $40. And that would be a hell of a deal right there. You're going to make good money off of that call. Now, the further out we go, all right, the cheaper it's going to be. If we say we go out here deep out of the money call at $44, that's going to cost us $114. But to break even, we need to hit 45. Now, what is important to know is you do not have to hit this break-even price to make money. The stock just has to go up enough to make money before the expiration date. Each time this stock goes another day without you selling this option, you're going to lose money in the theta, right? So the theta in this one, 0.24, we're going to take that times it by 100. That's how much money we're going to lose every day on this call. So we pay $295 for it. We're going to lose $24 a day, which means tomorrow when you open your Robinhood account, if nothing changed, you're now $24 less in the hole. And it's going to keep going that way each and every day. You're just going to keep losing money. So, calls, if you're going to buy them and be risky on a stock like this, you probably should look into doing something like a day trade on it if possible. Or, if you're really confident, if the stock starts to spike up, like on our chart here, and you think, all right, well, tomorrow it's going to keep going, hold on to it. What you don't want to have happen is something like this, right? I've got a Sendle call right here. Oh, let me pull it up. I've got a sundial call right here, a $3 call option. This expires this Friday, right? I paid $110 for this contract. Its break-even point is 410, which after last week it looked like it could have made it happen this week. I don't really know if it's going to make it. We're looking at the chart here. It doesn't look great, but anything could happen, right? Right now our market value is not great. We've lost some decent money on the sundial call, but it's also not over yet. So our sundial here could actually take off and get me back up into a profit zone just by getting close enough to that $4 mark. If sundial hits $3.20, I'll be in the money tomorrow for sure. So keep that in mind. If I hold this to expiration and it doesn't get up there, you can see right here my total return right now, $87 gone. You could be out that money 100%. That is the risk you take when doing options. You pay $110 for this contract. It doesn't get kind of close. It trades sideways. If you don't know what trading sideways is, I'm going to pull it up right here. We're going to pull up AMC because AMC is definitely trading sideways this week. When we look at our, say our 5-minute, this right here, this is sideways. This is not moving enough in this stock to make us any money. If we look here, this is 570, 80, 70, 80. This isn't going to make us anything on a call or a put option. It's just going to burn it to the ground. So the same thing kind of goes if we're looking to buy some puts. If you think that a stock is going to hit the ground, that like, Tilray here, for example, if you had bought a put right here on the 10th, the end of the day, when that sucker was $62, and you came in here and you bought a put option saying, I believe this stock is going to hit the floor, and you had bought one at, $30 strike price, and this thing closed at $29, you would have probably damn two to three extra money on that day. But keep in mind, if you don't sell it, if you hold it too long, it's going to burn to the ground. Now, if you want to trade a put or a call, you do think that Tilray is going to be a $50 stock in 3 months, change your expiration. Look at 3 months from now. Look at June 18th, right? These are going to be a lot more expensive. There's the chance of this stock getting there. Well, here we go to the calls. To get to the calls at $32, that's almost $1,000 option right there. So keep that in mind when you're trading these things. A lot of guys get on there and they talk about, getting options trading. You can make a lot of money options trading. You could turn $500 account into $10,000 in 3 months. Well, while all of that is 100% true, the risk involved in doing that is also extremely high. I made some good money last year on some calls and some puts. I got kind of lucky on a Aurora Cannabis call, and it netted me $2,000 when I was down. And that they just don't happen every day. If you can catch one of these stocks on the rise, sure, by all means, grab one. Just know that this price changes as the stock price changes. As the stock goes up, the call price goes up. As the stock goes down, the put price goes up. So keep that in mind. I don't want you guys to get burned out there because I've seen a lot of guys get burned. I actually have a screenshot I can pull up here somewhere. Let me see if I can nab it real quick. All right, here we go. This is a screen grab I snapped off of the Wall Street Bets forum there. It says, can anyone guess when I discovered options trading? And if you look at this account, man, that thing's down $45,000 all time. This isn't a 1 day situation. If you look at this is kind of his entire career here. But if you look at the line there, man, you could lose all your money. And I believe me, I've been there, done that. I haven't lost $40,000, but I've definitely burned $1,500 with the quickness, just following some trends that went the wrong way. And if you see something going the wrong way, and you don't see hope, get rid of it. Ditch the call while you still have a little bit of money left in it. I had a sundial call last week that was I paid $20 for the call option, or I think it was a put option, $20 for the put option, and at one point it was worth $18, which is a $2 loss, and at one point it was worth $24, which is a $4 profit. And I should have just ditched it. It wasn't a day trade; it was after a few days, and just retained my $24. But I didn't. I held it and thought, well, maybe we'll see. And Sundial did get down to about $2, $1.90, and my put option I think was at 150 break even, and it ended up expiring worthless. So you know, keep in mind some of these things are just casino games. For the short of it, and you don't end up holding the bag like this fella right here. That is what we definitely do not want. So I want you guys to just be aware of that. There are a lot of smart money investors out there that make good money, and they do kind of offer you up some good advice. And a lot of those guys, honestly, are long term holders. They're looking at someone. I think I watched Stock Mo talk about Neo. I've watched Meet Kevin talk about quite a few stocks. And when you look at, I mean, I remember not that long ago. I'm gonna even pull it up here. Not that long ago, when Neo was trading at $23, $24 a share, and we'll pull this back to the daily. Down this. I remember it was down here, and they're saying, "Oh, it could 2x, it could 3x." This is where patience paid off. It did. If you had bought in down here, not that long ago, September. This is 5 months ago. If you had bought into $18 and now it's trading at 60, that's 3x your money. So keep that in mind. You could have also, took your profits at 53, bought back in at 42, sold again at 61, and you can keep your shares up. So a lot of those guys do offer amazing advice for longer term investors. And then a lot of what I see on the TikTok stocks and some of these other ones are going to be immediate, short term, day trade options. That's what you're looking to pound, of these penny stocks. Keep in mind, it's a big risk. Big risk, big reward. No risk, no reward. So I want you guys to keep that in mind going into this week. And I'm going to make another quick video showing why I use 4 different trading platforms for my small investment portfolio that I have. So keep an eye out for that. And good luck this week.